Well, the big beautiful bill has passed, and it's got some good and got some bad. My name is Paul Vázquez with Tax Lab, and you need to become an ethical millionaire. So, I've now that the bill has passed and gone through all the government it needs to go through in order to be signed into law, I'm going to start really digging into it with you guys. So I want to talk first about that personal exemption that I said there was no talking about. I found it here in the bill. Now, there's one issue that's yet unresolved, and that's how the IRS will actually affect these changes. So there's the rule going into law, and then it's how that law is applied that can be another issue. So I want to call that to you guys' attention, because even if something is in the bill, how you think it might end up being applied might be different than what people believe, even those who are writing the rules, because it's kind of like you can create a big plan to build a house, and before you know it, maybe as you begin to dig the foundation, maybe you find out that there is some hard rock or something that's going to make it a lot more expensive to build in that exact location, and it might be better to shift it to one side or the other. So the actual application of the rules may change how it actually affects you or us. But unfortunately, it looks like, according to section 70103 of Title 7, Subtitle A. This is the tax section. And so 70103 says termination of deduction for personal exemption other than temporary senior deduction. So it seems like they're going to keep in the bump up for seniors on their standard deduction, but that the personal exemption for everybody else is terminated. Okay, so I've pulled it up here, the actual termination for deduction, by striking through 2018-25 in the heading and inserting beginning after 2017, by striking through before 2026, and by adding the end of the following subparagraph, deduction for seniors. In general, in cases of tax year beginning before January 1st, 2029, there shall be allowed a deduction in the amount equal to $6,000 for each qualified individual with respect to the taxpayer. Qualified individuals for the purposes of the clause: if a taxpayer attains age 65 before the close of the taxable year, and in cases of a joint return, so you got two people, limitation based on modified adjusted gross income. So you've got the $6,000 per senior over 65, with limitations. So if your gross income exceeds $75,000 or $150,000, then you don't qualify even if you're a senior. You are required to have a social security number. So it looks like they're pretty much making permanent the cutting out the standard deduction for everybody, but allowing the seniors to get that additional $6,000. Now that is up to 2029. So if you do not turn 65 by 2029, then it may be that you will never see a personal exemption again, even at that age. So this kind of gives room for politicians to negotiate for votes. It's a voting item there, so they're kind of giving themselves a reason to vote for one person over the other, depending on their rhetoric. But as of now, it looks like until year 2029, if you've reached 65 or older, that tax year, you get an additional $6,000 off of your taxable income. And that's if you are under $75,000 of AGI, or 150 for married filing jointly. So I just wanted to give that one to you guys, since I've talked about it, and I'll keep going through this and let you know what I find. I wish you guys all the success.